everyone. Thank you for joining and welcome to today's event titled A Practitioner Panel on Incorporating the Credit Impact of ESG Issues Using Moody's ESG Cross Sector Methodology. My name is Mark Duffy, and I'm a member of the CFA Society Boston Sustainable Investing Committee. Today is part of the CFA Society Boston's ESG series, which seeks to provide the greater Boston area with sessions on the topic of ESG. Last month, the Society held 2 sessions related to this. One on understanding social factors and another on fiduciary duty. We have more planned for you soon and welcome any feedback. With that, I'll turn it over to Michael Bryce, long-term serving chair of the Sustainable Investing Committee. Michael.
Thank you, Mark. My job today is really only to introduce the panelists and the folks involved and get us rolling, and then handle questions and answers. So I really do want to encourage you, since this is a practitioner panel, we brought 3 folks together to really spend some time on this new information, these new reports and tools, and they're going to share their insights with you after you get an introduction to what Moody's has put together. And then we really are going to have a dialogue, and we really encourage you, please use the Q&A. If there are questions that we can handle as we go along, we'll include them. Otherwise, we'll get to them toward the end. We plan to go a little under an hour and kind of flow into questions toward the end of the hour. And then we'll go an hour and a quarter or whatever, as long as the questions keep coming. But we are delighted to have you here today. I'm going to let our 3 practitioner panelists, they will introduce themselves when they actually come on so you can keep track of who they are and where they do. But I will mention Mark Duffy, CFA is now at Invesco, Andrew Terrace at Breckenridge Capital Advisors, and there's Ken Seifers at Impacts Asset Management. But to get us started, I want to turn it over to Swami Venkatraman, who is the Senior Vice President from ESG Analytics and leads the team that put these new sets of tools together. So Swami, I'm going to turn it over to you to do an introduction, and then we'll let our panelists get to work.
Thank you, Michael. Great to be here. Good afternoon, everyone. What I want to do is spend a few minutes just introducing myself, talk about what Moody's is trying to do here on ESG and our ESG scores. I have a few slides that I will share, and then I'll mention some examples of sectors that we have covered so far, that we have scored so far. And I have my fellow panelists, each of whom will take one of those sectors and talk about some companies or some issuers that they are familiar with. And we hope that that will set the stage for a good dialogue. My name is Swami Venkatraman. As Michael said, I'm a Senior Vice President. I manage ESG analytics and integration for Moody's Investor Service. So we manage a team of people, and we are responsible for coming up with the frameworks and the analytical approaches that we then roll out through the rest of Moody's to all the rating analysts for them to implement in incorporating ESG into our ratings. Let me share a slide deck before I go any further. And what I want to do today is talk about the Moody's framework first. What is it that we are trying to do? So in recent years, there's obviously been a greater focus on ESG issues by all parties concerned, issuers, investors, regulators, asset owners, and so on. And from a Moody's perspective, we've always been asked, how do you incorporate ESG at all into your credit ratings? Right, that's the first question that is often asked. And then second is, can you be more transparent about how you include ESG into your ratings? And then thirdly is, can you tell us more about what is going to happen to credit ratings as a result of ESG issues in the future? So we've taken those questions and that feedback, and we've gone back to think about how best we can serve the ESG market. And one of the things we decided is we can best serve the ESG market by sticking to our core competence of credit and credit ratings. What that means is we are not trying to be somebody who evaluates the sustainability characteristics of a company, for lack of a better word. We're not here as a sustainability research information opinion provider. We do look at sustainability, of course, but we look at it from the perspective of how those considerations may affect credit ratings. I'll talk more about that, but that's an important caveat that I wanted to mention right at the outset. And then in terms of how we actually incorporate this, let me walk through a few slides. This talks about our 4 pillars of our approach, if you will. I'll start from the top right and quickly explain those and then walk through each one of those in some detail. ESG classification essentially is the answer to the question, what is ESG? What is it that you look at? What issues are you concerned about when you talk about ESG? And we have come up with a classification of issues, which I will show, which is fairly, which talks about most of the issues that all of you would be familiar with, but it is something that we have created for the purpose of giving more transparency into our analysis. The second, at the bottom right, heat maps essentially speaks to what ESG issues are important for any given sector or industry. We have published a heat map, an environmental heat map and a social heat map for all rated sectors. And we have identified what issues are material. As you know, this is one of the big discussions when it comes to ESG, the question of materiality. When is it financially material? We have been transparent about giving you our view of materiality by publishing materiality on a sector-specific basis across all sectors. And this is a report that I would be happy to share with all of you if there's interest. The third at the bottom left is ESG scores. This brings the analysis from the level of the sector in the heat map down to the level of the issuer, where we publish issuer profile scores, or IPS, that speak to how any given company, the risks and opportunities that face any given company or issuer, as well as what management is doing to mitigate those risks or capitalize on those opportunities. It's a company-specific assessment. And then finally, that assessment is incorporated into our credit analysis. We come up with a credit rating, and along with the rating, we publish something called a credit impact score. And the credit impact score essentially answers the question, did ESG ultimately make a difference to the rating, right? Yes or no? So the main thrust of my focus today will be on the last two components, the issuer profile score and the credit impact score, which is what we have started publishing. But this is what I initially referred to as the ESG classification. What issues are we focused on when we do ESG analysis? So as you see, when you talk about environmental, it's the physical risks of climate change, carbon transition risk, water, waste and pollution, and natural capital. Some of these are well-recognized categories of risk, but this gives a structure to our analysis. Essentially, these are the issues that we look at when we analyze any given company as part of our rating analysis. What you see as public sector and private sector for social and governance is essentially a difference between governments, which is public sector, and that could be governments at the level of a city or a county or a state or a country, doesn't matter, but it's governments in general, or private sector, which is essentially everybody else. A heat map, this is just an example because these are two sectors, pharmaceuticals and mining, that we are going to be talking about later on. But this gives you a flavor of what the heat map does. If you look at the top heat map, which is the environmental heat map, the top two figures, and you see here carbon transition, physical risk, water, waste and pollution, natural capital. These are essentially our environmental categories that I showed you in this slide here. And so what we've done is we've taken every sector and we've scored them for risk against those environmental categories. So pharmaceuticals, not surprisingly, pretty much low risk on environmental categories, except for physical risk of climate change, where potentially a company may have facilities that are in locations exposed to physical risk. So you might have some exposure there. On the other hand, if you look at mining, it's essentially a 4 category, low, moderate, high, and very high. On the other hand, if you look at mining, it's mostly all high or very high risk, except for carbon transition per se. You know, we're not looking at coal mining here, we're looking at other metals and mining. So they are high risk for the physical risk of climate change, for water usage, for waste and pollution, tailings dams are a well-recognized risk. Natural capital, which is essentially the idea that mines tend to significantly impact the environment of the place where the mining happens, and so on. So in this way, we provide you for every single sector what the risk is for each ESG category. And so we are being very transparent about which issues we consider important. Similarly, below for social risks, we have 5 categories: customer relations, human capital, responsible production. Think of that as product safety, product recalls, supply chain issues, things like that. Health and safety of the employees of the company, and then demographic and societal trends that affect the demand for products, broadly speaking, that affect the demand for products, and other kinds of trends that may affect industries. And so again, I've marked pharmaceuticals and mining out again, what risks are high risk for them. So you have demographic trends and customer relations being high for pharmaceuticals. What that means is demographic trends speaks to things like the demand for, let's say, controlling pharma drug prices, or Medicare for all, and so on and so forth. Those that could have a huge impact on the industry. Those demographic trends, they are a high risk issue for pharma. And as are customer relations, which speak to issues like lawsuits around opioids, right, where people are affected by the drugs that they take. That's a very serious issue as well, and so on. So this is just to give you a flavor for what our heat maps look like. And for every sector, we have produced a similar environmental heat map and a social heat map. And then finally, before we go to the scores themselves, the ESG scores, the issuer profile scores, and the credit impact scores, I want to take a few minutes to talk about what they are and what they aren't. So let me start with what they aren't actually. As I mentioned earlier, the issuer profile score is not an opinion about a company's sustainability performance. We're not saying that this company is sustainable, that company is not. We are only talking about whether those considerations are affecting the credit quality of the company. So many might argue, for example, that oil and gas producers are very low on sustainability, and that's fine. But that doesn't mean that all oil and gas companies today are having, non-investment grade junk bond status. So our view is, our mandate is to speak to whether those considerations affect credit ratings today. So we're not opining on sustainability. We are not opining on the impact of a company's practices on stakeholders, and stakeholders might mean community, the broader employees. They're all stakeholders. We're not necessarily opining on that unless it affects the company's ability to pay debt service. We are not opining on the quality of disclosures. Our view is you can disclose a lot, but be a low risk company. We're not going to give you points for disclosure. On the other hand, you may disclose, let me do the other way around. You may disclose a lot and be a very high risk company. We're not going to give you points for disclosure. We are focused on the risk. We're focused on the underlying economic exposure, not on whether a company is disclosing adequately. We're not measuring alignment with UN SDGs or net zero carbon or any such goals. That's not what we're trying to do. Again, the focus is purely on credit. The issuer profile score also does not directly say what the impact on the credit rating is. That's the credit impact score, which I will come to. But what does the issuer profile score do, right? It does take a credit perspective, coming to the left, and it provides an assessment of which issues are material to credit risk while looking at both risks and opportunities, as well as management's actions to specifically address those issues. So that's our focus. Is there an ESG issue that can affect the credit quality of a company? What is the exposure? What is management doing to address those exposures? And in doing so, we are doing two different things. One, we want to emphasize the most material credit risk. We're not going to spend time talking about carbon risks for a media company, or water risk for a pharmaceutical company, where those risks are not really that important. We also want to make sure the scores are comparable globally and across sectors. This is very important. Just as the ratings are comparable across sectors, a BAA rating means a certain amount of credit risk, no matter what the sector is. We want our issuer profile scores to mean the same amount of financial exposure from ESG risks, no matter what sector or no matter what country a company is based in. And then the credit impact score takes these ESG issues and then places them in the context of other rating considerations, the last point on the left of the screen. It talks about whether ESG affected a credit rating, or rather it indicates the extent to which rating would have been different in the absence of ESG issues. That's what the focus is of the credit impact score. This is just a figurative, putting all of this together in one single slide. You see the 3 credit impact scores. It's a 5-point scale, E1 to E5, S1 to S5, G1 to G5. That reflects a combination of all the E, S, and G considerations that I showed you earlier. These scores feed into our rating methodologies, sector-specific rating methodologies that I think all of you are very familiar with. We arrive at a credit rating. And then once we arrive at a credit rating, we ask ourselves the question, is the rating any different because of ESG issues? And the CIS gives you the answer. And let me make this very clear. If you have a CIS of 4, what we mean is your rating is lower than it would otherwise be in the absence of ESG issues. We're making that very explicit. The rating is actually lower. If not for ESG issues, this rating would be higher. 5 is simply, multiple notches lower. The rating is multiple notches lower. 1 is where the rating is actually higher because of ESG issues. The company actually benefits from ESG. 2 is neutral to low, no impact on the rating, and not likely in the future. And 3 is moderately negative, which means it is a negative influence on the credit. There's no impact yet on the rating today, but there could be an impact down the road. So that's an interesting category as well, where we're saying, while there's no impact today, there could be an impact on the rating down the road. So that's sort of an introduction to the scores. Michael, what I want to do is I'm happy to briefly walk through the 2 or 3 sectors before I turn it over to my panelists. But I want to know if you think this is a time where I can take some questions as well on the general definition of the scores. Would you like to do that, or do you want me to talk about the sectors and have the panelists speak about them?
I think it's probably most helpful to talk about the sectors and let the panelists speak about them, because I think that will kind of prompt our audience, who are largely like our panelists, to have a better sense of what they want to ask about. So why don't we do that?
Okay, all right. So this is just shows the process that we come up with. We start with the heat map scores. We know what the sector is. We assign scores for all the 15 categories for every issuer. That's another thing. So you just don't have the 4 scores. It's not just the E, S, and G profile score and the credit impact score, but there are 15 scores associated with each of the 15 categories as well. So you know exactly which risks we consider important for each company. And then each of these is combined to produce the profile scores. So let me start by talking about pharmaceuticals and giving you a very sort of brief overview. The pharmaceutical company, if I may start from the top left, if you will, most of the credit impact is a CIS3, which means no impact on the rating at this point, but potential impact down the road. And that largely speak to the evolving and yet uncertain risks around opioid and similar litigation, as well as drug pricing regulations or other sorts of issues that we have. There are a few companies out of 4. This largely speak to the rating impact we have already seen, either because of opioid, largely because of opioid litigation, I would say, or similar litigation that we've had, where we've had some rating impact. And then, one company where perhaps because it has no exposure to the US, has a low risk impact. The environmental scores are not surprising, mostly a lot of neutral, some negative. The negatives that you see here are all largely because of physical risk of climate change and where the drug production facilities are located. And then and then these two are where that exposure is probably a little more extreme, a little higher exposure. The social risk, not surprisingly, is high or very high, largely refers to the US market risk as well as risks around the litigation. And governance, you see, is a little more spread out. There are companies that are really well governed where governance is actually a positive to credit. And then companies where it's more or less neutral, and then you have companies at varying degrees of, and when we talk about governance, we look at financial policy and how conservative it is. We also look at board related issues, disclosure related issues, and as well as compliance and control related issues. I do have the specifics of the scores with me. I can answer questions, but I just wanted to briefly explain what the scores look like. And this is what all of you should expect to see. And you will see, actually, if you go to moodys.com, you will see an ESG widget. This is the output that you would expect to see. You will see the 4 scores for every company and a brief rationale, if you will, summarizing why any company has these 4 scores. I just picked Merck and Endo as just 2 examples. Merck is moderately negative, no impact on the rating yet, but it does face exposure, especially on the social side over time. And then you have Endo, which is one of those CIS4 where the rating has actually been negatively affected. There is a governance impact as well as a social impact. And the social impact is essentially high exposure to litigation, specifically opioids. And then it's also branded business represents a large share of the cash flow. Therefore, drug pricing risk in the US is a key social risk for Endo. So we identify specifically what issues companies have. And then we talk about on the governance side, financial policy of leverage over 7 times is a big issue for credit as well. So you will see a description like this for every company in the sector. I similarly also wanted to walk through medical products. I won't spend too much time here. A lot of similarities with pharma. Social is a driver, but a little less so perhaps than the drug companies. And similarly, an example of an issuer, in this case, again, a moderately negative, but you do talk about how as a manufacturer of implants, they have exposure to lawsuits and about $2 billion of reserves to meet potential lawsuit related penalties. And then lastly, this is metals and mining, very different profile. You see huge environmental risk, largely, and I don't have to explain mining, I think all of you can very clearly understand. There's also a lot of social risk. Actually, it mirrors mining in the sense that they are interrelated. The environmental attributes of mining are what cause the social risks as well. And responsible production is very high. What that means is your relationships with the communities in which you're mining becomes very critical in terms of how you're licensed to operate, you're licensed to mine in any given country. You have a larger number of companies that whose ratings have been affected, whose ratings are different because of ESG issues, and quite a bit that is negative as well. And Alcoa is one example. This one happens to be neutral in terms of the CIS impact, but a very similar sort of description of each of the 4 scores that we have. Vale is the one in mining where there is a negative impact, and we are all familiar with Vale and their dam collapse, tailings dam collapse, and so on. Very high social risk, very high environmental risk for them. This is Anglo. Again, high environmental risk, high social risk. Happy to go into the details. I just want to show the sort of output that you will already see and that you will see for more sectors. This is coming back to my last sector, which is US public finance. These are the scores for the 50 states. And you see an interesting pattern here. A lot of states where ESG is largely not a big driver of credit, but you do see some where it's positive, mostly driven by governance, which is such a huge driver. 39 states where governance is seen as a positive for credit. But then there are a few states where the scores are negative as well. driven by a combination of environmental and a combination of social sort of issues. But these are both states and territories where we've assigned ESG scores. Utah as a positive example, which is essentially S1, G1, where both the demographic profile and the governance are very positive for credit quality. And Illinois as an example where the rating is lower than where it would be in the absence of ESG considerations, and then largely driven by a combination of social and governance issues. Similarly for US cities, we haven't scored all cities, just a sample of them, only those that have at least $1 billion of debt outstanding. And this is so I don't want to make a representation that this is reflective of all cities that we rate. It may not be, the pattern might change, but this is what we've seen among the largest cities that have at least $1 billion of debt outstanding. Again, Jacksonville as one example, CIS 3, and District of Columbia as a positive S1, G1 from a credit perspective. So maybe I will stop there. I've given you, what I want to say is, before I turn it over to my panelists to walk through these three groups of sectors: pharma, medical devices, mining, and US public finance. What I want to say is we've only published about a couple more sectors we published that I haven't mentioned are utilities, packaging, coal mining, sovereigns. We've published sovereigns as well. So there were 8 or 9, so about 500 scores are live. This is a highly analyst time-intensive process. We are not simply collecting data from somewhere and formulaically assigning scores. The same analysts who produce our credit ratings also produce these scores. And the approach we are taking is something very similar. Very much like rating committees, we are sitting down, analyzing an entire sector at one time. So it's a very time-intensive process, which explains why we are publishing scores slowly, sector by sector. But our intent is to roll out thousands of scores over the course of the rest of this year and part of next year as well. Effectively, over time, we would like that all ratings that we have will be accompanied by an ESG score. That's where we're looking to get to. But what I would like to do is make sure all of you as investors understand our scores, what they mean. And what I'd like to do now is, before I turn over to my panelists, what I would like them to do is talk about their sector, maybe a little bit about how they think about ESG, and maybe pick up one or two of these examples and talk about how they see those companies.
Terrific. Mark, I think you're going to kick it off, right?
Right. Hi, everyone. My name is Mark Duffy. As I mentioned, I'm an ESG analyst on the global investment team at Invesco. My current role, I work at the investment teams across North America, fixed income and equity, to support ESG integration and engagement. So a little bit about my background. I joined Invesco last month after a 5-year stint at Longfellow Investment Management. There, I researched corporate credit and I led the firm's ESG integration efforts. My industries of focus at Longfellow were consumer goods, capital goods, healthcare, whereas at Invesco, I'm more of a generalist in terms of sector coverage. I became a member of the CFA Society Boston in 2016, Sustainable Investing Committee in 2017. ESG for me, under the really the credit umbrella, was viewed as more of a risk than an opportunity. In equities, viewing the risk and opportunity a little bit more balanced. That's all I have. And I'll actually also continue on to kind of the industry sector analysis here, and really starting with pharmaceuticals and medical devices on page 9, please. Yeah, so as we navigate to page 9.
Which is this one, is that correct?
Pharmaceuticals and IP, that one, correct, yeah.
Yeah.
Okay, cool. So, you know, the pandemic was certainly a disruptor for the healthcare sector broadly, and definitely pharmaceuticals and medical devices. They also played a meaningful role in breakthrough of vaccines and just testing equipment. So definitely a lot of opportunity there for this sector. That impacted really the reputation of the company and their customer relations, positive impacts there. However, as I mentioned, credit, we're looking more at the risks here. And so this discussion more focused on potential negatives that can arise in the risks. So within E, S, and G, the credit risk for pharma and really med devices is concentrated in the S, it's social. There is a bit of environmental risk, as Swami has mentioned, low to moderate for Moody's. This is because companies generally consume resources efficiently. However, they do have facilities in Puerto Rico, namely, that have been impacted in the past, namely Hurricane Maria in 2017. Fortunately, no financial impacts from that hurricane, but it shows that there is this kind of physical risk that needs to be watched on the environmental side. For social, as Swami has also mentioned, it's responsible production, customer relations are really the key ones. Countless real life examples of where these risks turn into big financial impacts. So many of those examples, they relate to off-label drugs, prescription of those drugs. And really, what off-label drugs are drugs prescribed for medical conditions they're not necessarily approved to treat by the FDA. So as I'm sure the audience is aware, the opioid crisis was an off-label kind of issue that had arisen, had far-reaching impacts across the healthcare landscape that's still being resolved and settled today across pharmaceutical supply chain and distributors and even retailers. So regulatory risks, they really vary across depending where they're selling these drugs. The country, the US region, presents more of a headwind due to the ongoing drug price debate. So if they're in the US, they get a little bit more of a knock with the Moody's assessment. So next slide here, please. Yeah, so turning to slide 10 here, just wanted to walk through a case study here and now, material risks for Merck, a pharmaceutical company I'm sure everyone's aware of. Moody's, they've given Merck a credit rating of A1, credit impact score, the CIS of 3. So the CIS is categorized as moderately negative. So indicates Merck's credit rating, it wouldn't be higher without the CIS. If Moody's were to ignore or neutralize the ESG risks, it's still an A1 company. So the negative, the E and the S, they're partially offset by the positive G for Merck. Like many pharma companies I've mentioned, Merck has manufacturing plants in Puerto Rico. They sell drugs all over the world, so it has exposure to many different regulatory regimes. And it has a somewhat weak track record on product safety based on products that have ended in litigation and recalls, but solid governance policies. And I just wanted to give a kind of a brief case study here on Merck, particularly. In 1999, analysts estimated Merck's liability to Vioxx to be in the range of 20 to 50 billion. But under the guidance of Kenneth Frazier, Merck fought these cases and ultimately settled for roughly 5 billion in 2007, 8 years later. So the event had minimal impact on Merck's credit ratings, and they maintained well above A this entire period. But you can see from this example that effective governance, strong liquidity can more than offset social risk for Merck, and why a 3 does seem quite suitable. Now, I just wanted to share another case study on Becton Dickinson, if we could go to that slide. So generally, the ESG risks facing the medical devices sector and industry very similar to pharmaceuticals, as we've mentioned. Becton Dickinson has a Moody's credit rating of Baa3 and a credit impact score of 3. So at a high level, you can see that E and the S very similar to Merck, but the product set quite different. Becton makes medical equipment, some of which are inserted directly into the human body. So high risk area, medical devices, the surgical equipment, I would say, compared to other companies that sell equipment to labs like Thermo Fisher and Danaher. So one of the bigger controversies for Becton has been related to their catheters in 2010. The payout related to that generally immaterial to the credit. However, Becton does face several lawsuits that are ongoing, really related to filtration and hernia products at the current moment. Settlements, they've not been reached in those cases, but Becton adequately reserves, at least from their stance, $2 billion for legacy product matters. So seeing effective governance. So generally, Becton Dickinson assessment for governance is decent, I would say, and Moody's comes across neutral to low impact for governance. So it's primarily the company's financial policies, including the well-articulated leverage target, and also willingness to use equity financing. That's bolstered this governance assessment, and again, a 3 for the company. So both Merck and both Becton 3s. Credit ratings would not be different without that CIS. So in conclusion, wrapping up, in my view, Moody's credit impact score, the ESG analysis, highly beneficial to the practitioner's standpoint. I think it clearly articulates why ESG is impactful to a particular credit and what metrics they are believed to be impactful. I think it only helped to monitor these risks over time on the analyst side in rating agencies. That's it for me.
Terrific. Thanks, Mark.
Thank you,
Let
Mark.
me switch over to Kent and let him take over.
Yep, this is Kent Seifers. I work for Impacts Asset Management as a co-portfolio manager in the high yield fund. We're a boutique sustainable investment firm that's focused on the transition to a sustainable economy. We manage just under 50 billion in assets across many different products, whether it be equity, fixed income, or private equity infrastructure funds. So I'm going to look at the metals and mining sector. If you know, a little very similar kind of approach to what Moody's has done. We kind of take a 4-pronged approach to ESG integration from a credit analysis side. The first thing that we look at is similar to Moody's, is that we use a sustainability lens that looks at the overall sector analysis. The second thing that we look at is the ESG scoring at the issuer specific level of the credit. Third, we look at how we engage with the companies in changing in policies to support this transition to a sustainable economy. And then the fourth thing we do is take all of this and see how this should be priced into the actual credit and how or where is there mispriced in the actual marketplace. So very similar, if you look at the Moody's approach, you know, we screen the metals and mining industry poorly as well due to its over environmental risks. We tend to underweight this sector in general. Some of the themes that we play from an ESG perspective is we have a lightweighting kind of theme with aluminum material for population growth and social trends. And then on the copper side, we look at the build out of the electric infrastructure. So we play those two themes across the portfolio. And then the third thing that we look at that might have been topical in the pharmaceutical industry is we look at some of the sovereign risk with metals and mining assets, because a lot of them are in EM countries. And so we want to make sure there's no stranded assets. So we tend to invest in companies that have assets based in the United States and Canada. You know, throughout the metals and mining companies, they all have created sustainability reports, but there's a few key measures that we really try to focus on, very similar to Moody's. The largest focus sector is on of the ESG is on the E, which is the environmental policies. Here we're looking at lowering greenhouse gas emissions, reducing landfill and water, landfill waste, and lower water consumption. We're also looking at companies that are improving their energy consumptions. And this is shifting away from traditional sources like coal and transitioning to renewable energy. We also look at tailings management, and this is for protection of stranded asset risk. 4, we have rehabilitation of mine sites, and then 5, recycling input usage for processing, where we're looking at the metals and mining sector in general. So the first, as I said, that we take as an overall lens scoring that we do, we categorize it and we measure it into high, neutral, and a low score. And so underneath these scores, we have, you know, some of the sub-industry, we have different categories as well. We have 8 that are opportunity sets and then 9 that are risk categories. So we kind of look at a group of about 17 sub categories within the overall sector itself. And similar to the Moody's practice is that we score these in ranges from 0 to 5. 5 being the highest opportunity or the greatest risk designation. So we look at metals and mining from a lens perspective. The first thing that we look at the sector level, we categorize it very similar to Moody's. We think it's a neutral space. And so if you look at where I think the credit impact score was CIS 3 for this sector, you'll see most of those that lie kind of in the neutral bucket there as a CS3. And so that is very similar to us. And those subcategories that we're looking at are enhanced productivity, which the metals mining score is very low with a 1. We address climate change, which we said is a risk, that's a 3. And then a resource efficiency is a 4. And then the overall lens is across all sectors. And for the metals and mining, we don't actually score a lot of those sectors. And that's well-being and nutrition, access to finance, digital infrastructures that just don't apply to this particular sector. So I think that's pretty similar to what Swami has described to make sure that it's relevant for the sector. Then, from a risk perspective, we think metals and mining is very high. And this is, the climate change, we think we score that a 5. Under resource constraints, we score that very 4. In pollution and waste, we have a 5. And then labor constraints a 4. So all those kind of subcategories that we do also screen very high from a sector level perspective. Once we dive into the ESG characteristics, we will go into, why don't we switch to the Alcoa example there, Swami, if you want to go to that slide. So, when we look at, this is where we probably differ a little bit more. And this is a function of how we actually address our E, S, and G at the issuer specific level. We kind of take a little broader fundamental approach with how the sustainability policies are for this company. And so as I said, the sector, the E is the greatest weight. But for Alcoa specifically, we look at the policies that they present at the companies. So for example, the carbon transition. So this is reducing the greenhouse gas emissions that they've already, and from a policy perspective, is to reduce by 30% by 2025 and then 50% by 2030. Under waste management, this is to look to reduce total water consumption from defined water scarce locations to reducing the bauxite residue land requirement per metric ton of aluminum. And they've stated a goal of about decreasing this by 15%. And then on the waste and pollution side, they look to reduce by 15% their landfill waste by 2025. And then by 30, they're going to reduce this by 25%. So when we look at the overall policies of the company, then we drill down, and a little different maybe than what the categories are. If we take on the environmental, the E2 rating, for Alcoa is the fact that we weight each one of these subcategories. So most important thing for us is the carbon intensity, and so we'll weight that as well as, and I think we go into, and you can, Swami asked this, is that I don't believe you guys weight your actual subcategories, which I don't think you have on the slide, but is that correct?
That is correct. We use judgment to decide where the score has to be. We don't have specific weights for each of the categories.
Yeah, so I think that's probably one difference of how we look at it, is we try to weight which we think are the most important subcategories within the E, S, and G based on the company and the policy that it has. So I think that's probably one difference in the ratings, and how this is a CS2 is probably very similar to the way we would rate Alcoa within the metals and mining group. Majority fall under probably CIS 3 rating, or if not CIS 4 and CIS 5 rating overall. So as far as the governance structure, that's really important as well. Can you guys still hear me? Hello? Hello?
You're fine.
Okay, sorry, I thought I lost you guys. So overall, we think that Alcoa is one of the better performers, with one of the better ESG rated companies, and one of the better credit profiles within the metals and mining space. And the other thing that we look at is the engagement policies of what we're doing with these companies. We'll be contacting, writing policy letters to the board of directors. We're also trying to engage with management, making sure that the policies that they are, saying in their CSR reports is that they're on track. And so we really tried to go ahead and stay on top of that. One of the other things that Alcoa has that we like is just the products that they have within. They've announced their sustainable aluminum wheels for the Audi e-tron GT. This is one of the first vehicles to ever use metal for technology that eliminates CO2 emissions. And then as well as Alcoa is inventing a zero carbon emissions technology, Elias, that will also start providing their first kind of green aluminum product within the market. So overall, I think the rating of an E2, which I believe is what you have, I think is similar in a CI2 report. And so I think we have a relatively similar approach in general to the report, and it's a great cross-reference overall to how we're looking at it from our credit scoring internally at Impact. So I think that's all I have on Alcoa.
Terrific. Thank you, Kent. Let's move over to Andrew to talk a little about governments and muni.
Yeah, excuse me. Name is Andrew Terrace. Thanks for having me at this event. I am a research analyst at Breckenridge Capital Advisors. We are a fixed income investment shop based in Boston. We have about 45 billion in assets under management. We invest in corporate securitized and municipal bonds. I am a research analyst and work on the municipal bond side of our business. So look at a bunch of different sectors within the municipal world. And so just touching on just getting specifically into specifically what Swami was going into in terms of state and local governments. I can make a couple comments there. I think first overall, one of the things I wanted to point out that stood out for me looking through this and hearing Swami give this presentation was, I think we really like, from our perspective, the way we approach ESG at Breckenridge is that this is a full integration process. So by that, our analysts are doing their traditional credit analysis, but they're also layering on top of that this ESG analysis, and it's done, in conjunction at the same time, and it's done by the same analyst. So there isn't this like separate siloed group. All of our analysts are sort of experts in ESG, just as much they would be experts in whatever particular sector that they're analyzing. So I think I did like that, sort of approach that Moody's is doing here, where they're getting their analysts involved in this process, and there does seem to be some integration. So I think that should be applauded. So that was one thing that jumped out at me, just specifically in terms of like thinking about ESG risk and governments specifically. And when I'm speaking about governments, I'm speaking specifically about in the US. That's sort of my expertise. So that's where I'm going to address my comments today. There's some differences in terms of like when you think about what these other guys were sort of talking to you about in terms of some of these sectors in the corporate world. Obviously, unlike a corporation, there's some differences. Cities have fixed boundaries, right? They can't relocate to avoid ESG risk to any extent, really. I mean, for most extents, they can't diversify their business lines. They don't make strategic acquisitions, things like that. So, this is most commonly seen in terms of like physical climate risk, right? So if you're a municipality and you have physical climate risk, there's not really a lot you can do about that in terms of like trying to avoid it. You have to think about how to adapt to it. and mitigate it. So that's one thing in terms of like a difference that we think about for municipalities. The other thing is like in terms of disclosure, in terms of the information you're getting. This is true generally of any disclosure that you get for the municipal market, whether it's financial information or some of this newer sort of ESG information. We are, I hear a lot of corporate analysts, they speak about equity analysts. They speak about just like, we need more disclosure of ESG data, and that's definitely true. But if you think about, you have to think about sort of the municipal world is like light years behind where the corporate world is, or light years behind where they are in Europe, where things are much more sophisticated and further along. So that's a constant challenge that I think that we deal with in the municipal market. Beyond the biggest issuers, New York City or the state of California, for example, there isn't a lot of great information that you're going to get, and that's particularly true of ESG data. So thinking about some of the analysis that Swami showed in terms of states and local governments, we're generally, some of the data in terms of the distribution of scores, I think we're generally aligned for the most part with what Moody's is thinking. I think speaking specifically about local governments, I think some of the data, Moody's has not scored all of the local governments, but they've done, my understanding is I think 113 cities is the data that I had seen. And those are the cities with at least $1 billion of debt outstanding. The thing that stood out to me was, 98 issuers have a credit impact score of CIS 2 or CIS 1. I think most of those were CIS 2. And there's only 5 issuers that have credit impact scores of 4 or 5, right? So to me, think about that. It's not all that surprising. These are the largest issuers in our market. If you look at the credit ratings, 88 of them, I think, were AA or higher. So these are very, very high grade issuers. And, it's not all that surprising. I think that aligns sort of with what we think in terms of like where the ESG risk is most acute. This is probably true of a lot of sectors, but I think in the muni world and the states and local government world, I think there's 2 categories of issuers that we would really worry about. Number one would be smaller issuers that have a large magnitude of physical climate risk, where they don't have necessarily the resources or the size and sophistication to sort of mitigate those risks or fund sort of adaptation investments. And number 2 would be, I think, lower rated issuers where there's already some baseline level of credit distress. So if you think about ESG risk, it's sort of like a threat multiplier. So if you already have a place, let's say they're struggling to fund their pension costs, they have very high pension costs, and then you layer on top of that some sort of ESG risk that goes along with that. Those are sort of the types of issuers that we would worry about. And so the subset that Moody's has scored so far, the vast majority of these issuers are not either of those categories. So, like I said, it does make sense to us. I think in terms of like looking at E, S, and G, I think the G, sort of the governance considerations in terms of the issuer profile scores, in terms of what Swami presented for local governments. I was interested that 84 of those issuers have a G1 issuer profile score. So that's the highest score you can get. And that seemed, intuitively, to some extent, it makes sense to me that the governance scores would be very high for these issuers, again, because they're very highly rated, they're sophisticated, they generally have pretty good management. But I thought that was, that seemed like maybe too many to us. Like I was surprised that it was that many that were scored in that highest category. I was wondering if there would, more, generally the way we think about governance, I think we probably have a broader, like a more normal distribution. We would have more granularity in terms of how we're thinking about governance. One other thing that I can mention is in terms of how we're thinking about that didn't come up, and I know it's a hard thing for a rating agency in general. This is probably true of just general credit ratings, but also for when you're thinking about ESG risk, is the time horizon issue. So how do this is something that we struggle with, but if we're buying a bond that's like a 4 or 5 year bond, versus a 30-year bond, right? How do we think about the differences in the risk for some of these things? And again, I keep coming back to physical climate risk, but I think, you know, that's a good illustration of, you know, if I'm investing in the city of Miami or Miami Beach, for example, you know, I'd probably care a lot more if I was buying a longer bond than potentially in the near term. You know, so there's just, it's sort of like, how do you deal with that? Maybe Swami could actually address that if in the Q&A, or you know, it's how do you address the time horizon issue? So that's another thing sort of that I sort of try and wrap my head around. You know, I guess I'll probably stop there. I've talked for long enough. I can go into more detail about any of the U.S. public finance information that Swami presented.
Thanks, Andrew. That's terrific. So let me ask you briefly just to comment on the one point Andrew made, which is about, you know, very high governance. They were clustered, and you know, when Andrew and Breckenridge led, they sorted differently. Maybe just briefly, but then I'd like to really get back and dig into the time horizon issue. Let you speak about it, Swami, and then maybe have Mark and Ken jump in too, because that's always been, you know, a critical question when looking at ESG and credit.
Understood. Thank you, Michael. So on the governance issue, there are 2 points I would like to make. One, I think Andrew mentioned it already, is that a lot of these, our definition of governance also includes financial policy and financial management. So we're not looking at governance only from the angle of controversies or other things like that, right? We're also looking at and given that most of these states and cities are all, as you pointed out, you know, AA category or high A, AA, many even AAA ratings, it's not surprising that they have very conservative financial profiles, and you know, and so that largely explains why they have very strong. The other reason I want to point out too is we want these scores to be comparable across sectors. And so when we look at corporates and when we look at this, we see the public finance market, and this is something, it's us calling something out. What we're saying is the financial management and the financial policies of the public finance market, states and cities, really stands out. That if you have a 5-point scale where you want to put the entire world, all sectors on one scale, most public finance names end up being at the top end of that spectrum. It's really hard to compare. Most corporates, even some of them do, like pharma companies. You can see there are many AAA rated pharma companies who do have 9, 10 of them. They have a G1 score as well. So it is not that others cannot, but we are really reserving that for cases where the financial policy and management is really contributing to a strong credit rating. So that sort of explains in our mind. I agree that if you really said, we want the 1 to 5 scale to be entirely utilized by just municipal utilities, municipal credits, then yes, I might be able to find a difference between them and say, hey, state X is better than state Y. Why don't I move them to a 1 or a 2? But really, when you look at this larger thing of making the scores comparable across sectors, we concluded that pretty much all of them had a G1. There are some G2s and 3s and 4s, as you see here, but a lot of them have. So that's sort of our perspective, at least, on why the scores ended up there. On time horizons, what I want to make clear is our issuer profile scores explicitly look to incorporate long horizon risks in the profile scores. So if you see a lot of the oil and gas companies and so on, they would have 4s and 5s. Let's say for climate change related issues. So where the difference would be is they might not have 4s and 5s in the CIS, meaning that yes, the exposure is there, but the rating today is not yet affected by these. So that's the perspective that we take. I can look at, I'm assuming that, I can look up specific states if that discussion comes up or if the questions come up. But the idea is when we look at the exposure of a state, we also want to look at the actions that the state is taking to manage those risks. And also, for example, when you look at a particular state, let's say physical risk, rising sea levels or some of the other things, part of the analysis that we try to do is what percentage of the GDP of the state is exposed to those risks. If you have rising sea levels that can take away some land, but there's really zero economic activity or people living in that land, the credit impact was going to be less. So again, somebody else might say, look, you're going to lose land. We are going to put you as high risk. But at the same time, we are able to say, look, if there's limited economic activity or limited people impact in the place that's going to be affected by sea level rise, we can actually score that as not so high a risk. So there are, we have an affiliate called 427, which is a company that Moody's acquired 2 years ago that does provide, it's a startup. Essentially, think of them as a bunch of PhDs who are able to look at climate models, UN climate models, and translate those into actual temperature, rainfall, and other wildfire and other sort of impacts, hurricanes, at different points on the earth. And we use some of their scores to help us get a sense for which parts may be more or less exposed to some of these risks. But the broad message on time horizons is, if you have very large long-term risks, you should expect those risks to be incorporated or reflected in the IPS, in the issuer profile score. The credit impact score speaks to, well, did those actually affect ratings today? And the answer may be yes in some cases and no in other cases.
Yeah, I think this is Kent. I think, Andrew, you make a good point about the time frame. One of the things that we have a problem with, or is difficult, is in the metals and mining, is that the sovereign risk that you face and the stranded asset risk of being invested in assets when companies can change royalty policies with those countries, based on elections. And it is a difficult, to evaluate that from a time perspective. And it's kind of evolving. And we tend to default to more US-based assets and Canadian assets for that reason, because the reality of being able to really measure that risk, we find is a little difficult. I guess I have a question on maybe for Mark or for the pharma sector, or for Swami. When going through the ratings on the pharmaceutical side, I was curious about how you guys look at the pricing of drugs versus maybe the distribution or marketing and sales practices of drugs.
Right.
How do you differentiate between the scoring from those two perspectives? Because that's one of the things that we look at a lot. What is controlled or what is not controlled by the actual producer?
Mark, do you want to go first?
Yeah, I was thinking the drug pricing kind of aspect is kind of captured in the regulatory. So region, location would be my thought. And then, kind of the customer relations, false marketing would be its own factor consideration. So Swami would be interested to hear.
Sure. I was going to say the same thing, but just to make it sort of more explicit under our classification, the drug pricing issues are a U.S. policy issue, and we look at that under demographic and societal trends. Because there's sort of, it's a social issue, so to speak. It's a issue classified under that category. And how we measure that is, when we look at companies, we look at a few different things. We look at your share of branded drugs versus generic drugs, because branded obviously has more pricing risk. We look at exposure to US versus non-US. So that US market, greater the US market exposure, the greater the credit exposure to a particular company. We also look at exposure to payer. So the greater your exposure to Medicare versus private insurers, there may be greater exposure to pricing pressure. So we look at these different types of metrics to help us understand where that is, and that score, that reflection of pricing pressure, largely is reflected in demographic and societal trends. And then again, as Mark was saying, false marketing and lawsuits related to opioids or talc, as in the case of Johnson & Johnson and so on, would largely go under customer relations, and we score there. So when you look at Moody's.com, you would actually see the scores for all of these entities. I might even be able to pull it up as we speak, but we can move on to other questions. We publish scores for all the 15 categories, and so you would be able to see how we look at customer relations risk for a particular company versus demographic and societal trends risk for a particular company, and so on.
Okay, let me encourage folks, if you do have questions, put them in the Q&A. Let me ask kind of a broad question, and it's been covered in some of the conversation, but I want to do it explicitly. One of the biggest challenges that everyone in this field is facing now, and one of the biggest complaint points, is the comparability of ratings, scores, whatever, those words aren't always used correctly, but this issue of comparability and understanding them. And it's a lot of ink's been spilled, a lot of research been done. Some of it's quite good, but the issue really is, when it comes down to it, is people are looking at different things, they're asking different questions, and they have different priorities. And so the key then is not so much that different ratings, I don't want to call them agencies, but different people who provide ratings and scores do it differently, but understanding, the transparency to understand what they're doing. So you as an analyst, or you as someone working with these companies, industries, can come back and say, okay, now I know how to use this information. Let me ask each of you, as you've looked through what you've seen today and worked on this, how well do you feel that is kind of reflected here in what Swami's presented and what you saw in these reports? Do you feel like you understand what's there and can interpret it and use it appropriately, however you wish to use it?
This is Kent. Maybe I'll go first on that. I think the most important thing from probably the panelists is how the market perceives this, right? And then just being able to look at some of the scoring that Moody's has done kind of gives you a directional pool to whether there's going to be an upgrade or downgrade from a credit perspective. It may not be the driver of it, but eventually you want to get to what's really being priced and how that's being priced. And so you may look at different factors from different rating agencies or Sustainalytics or other third-party providers, but the reality is you want to use the tools that you think eventually they're going to help you outperform in the marketplace. So
I would agree with that. I think it's it's transparent what Moody's is trying to get with the CIS, and the way that the ESG section is integrated into the credit reports, and with the qualitative analysis. I think it's it's really helpful to really boil it down to those material, see what Moody's is thinking is material from a credit standpoint, compared to maybe third-party agency reports on ESG, which are very lengthy and kind of speak to many other stakeholders as well at times. So the credit applicability and the transparency around it and the qualitative input, I think, is really helpful for Moody's here. And what I'm interested in seeing going forward is, now that these risks have been parsed out, for instance, pharmaceuticals, we've identified it's kind of a neutral CIS impact, and these factors are offset with governance. Now that they've been explicitly outlined, and how they evolve over time, does that, now they're kind of segmented in the analysis, does that shift the rating more? Before, is kind of all kind of conglomerated in. So we'll see if there's more of a pull on the rating with the CIS now that's explicitly defined. That's just my takeaways.
I would just add, echo this comments already. I think also, one thing that I've found is, in terms of like when I pull up some of the examples on in terms of like the individual scores, like I was looking at the city of Los Angeles, for example, their credit impact score and their issuer profile scores. For each of the 15 different, I think there's 15, right? So 15 different ESG factors. I found myself, for physical climate risk, for example, the city of Los Angeles gets a 2. I think that's interesting, and I'd like to know a little more about that and sort of like what are the drivers behind that. And I would assume as we go forward here, my understanding is there will be additional information provided. You can reach out to the analysts to get more information, but just what are the inputs behind that? I know you guys are using 427 data, but what specifically is driving that? Just because one of the interesting things I think about a lot is sort of like when you think about physical climate risk is just because you're on the coast, in terms of sea level rise risk. Los Angeles has much different risk profile than Miami Beach does, or even a lot of communities in the Bay Area. So it's not necessarily that we're in a disagreement with what you have here. I just, if I wasn't as knowledgeable, I might want a little more information and try to understand, wait, why is LA lower physical climate risk than Miami or Miami Beach. So I would just encourage as much transparency as possible, which I know you guys are working on.
Understood. Thank you, Andrew. Yeah, I just pulled up LA in case you want to show. I wanted to make sure the audience also sees, and I'm sure most or all of you hopefully are very familiar with Moody's.com. And we have this new widget added here recently so you can go to the landing page of any issuer, in this case, the city of Los Angeles, and you will see this ESG widget here with the 4 top scores, but you can click on the scores link and you will get the individual scores for all the 15 categories, and then the top level scores and the write-ups. This is what you saw in a slide form, slightly differently formatted, but so you should see this for all your companies. Only 2 points I wanted to make is as Mark was saying, there are people who take different approaches to ESG, different perspectives to ESG, and they're all valid. We're not here to argue about us having the correct objective. But what we do have, as we say, is our focus is credit. So to the extent that you're interested in how credit ratings might be affected by ESG, I would say we have the product for you. And if you are interested in other aspects of assessing sustainability practices of a company and so on, then yes, there are other providers in the market who might provide that. So the way we see our role here is focusing on credit and being very transparent about what we think about a company's exposures to various ESG issues, credit exposures to various ESG issues. Over time, Andrew, you're correct. That's exactly what we want to do. What we hope to provide is partly, this is a question of the work and the technology also platform catching up with what we can do analytically, is hopefully be able to provide you with a rationale like this, not only for the E, S, and G and the CIS, but even for physical. Why is Los Angeles a 2 on physical climate risk? You know, and maybe a click there and something pops up to explain why our view is. We hope to get there, but even today, you should certainly be able to pick up the phone and speak to the analyst, and he or she will be able to tell you what the thinking was behind that score. Not sure who the analyst is for the city of Los Angeles, but I'm sure you know Andrew, and certainly you can, you should be able to get that clarity from them.
I mean, this is Ken. Maybe you could go to the Alcoa ESG score page, because I had a question on that specifically with the categories and the weighting. You get to that one and you drill down, yep, pushing the scores. So when I was going through this, it seems pretty, you go to the social factors and you see that if you see everything's got, there's 2 2s, there's 3 4s, so you get an S4 for the social profile score. And then for the governance, you have primarily all 2s, and then you have 1 4, and then you get a G2. So that's pretty straightforward, I felt. But when you go to the environmental and you see the E5, and you only see one E5, which is the natural capital, and you see the sector side being very, very high risk, but the other scores are 3s and 4s. It's not as, to get to that E5, I was curious as to how, and this comes into maybe the weighting of to these categories, how that works. You can explain that a little bit, because that was of interest to me.
That's a great question, Kent. It's one of the things that I didn't get into while I was just talking about the scores themselves. What we ended up doing is we wanted to score all of them, but clearly not all of these issues are equally important to every company, right? So here, like, carbon transition is only a moderate importance. The others are pretty important. So in this, what we decided to do was we decided that we wouldn't weight in any sense of the word, but rather we would use our judgment to, and well, maybe before judgment comes into play, our starting point might even be the max risk, if you will. And the idea behind that is, if you are a 5 for carbon transition, let's say that's a huge issue for you, carbon transition. Let's say you're 2 for water management. Water is not much of an issue. The fact that you don't have water risk does not prevent carbon transition from affecting your credit quality. That is a huge risk. right? So what we said is our starting point is going to be the highest risk or the worst risk, because that risk can affect your rating. The fact that you don't have issues in other areas, yeah, that's okay. You don't have issues, but that one risk might affect your rating. So that's a starting point. But that's not to say that that's where we would always end up. In this case, we did end up at that level, at a 5 for natural capital, saying that, look, these issues are important enough that the ability of a mining company to manage mine sites and restoration and the tailings dams and other things that go is so critical and so important that we think that drives their overall score, no matter what other things, no matter where other things are. That's broadly where we are. Sometimes you will see a case, you may have 3 4s ending up at a 5 even. Theoretically, that's a possibility, because what we're saying is you have high risks in 2 or 3 different areas. We think overall that's a very high risk for you. That's a possibility as well. Occasionally, you will end up situations like here, where you have a 4, but it's not really pushing up the score. It's ending up at an overall 2, because we think that if you look at all of these, we think that financial strategy or policy and management credibility are the overwhelming factors driving our view of governance. If those 2 are great, we think that's where governance goes, even though the other things might be a little worse. So I think fundamentally the way to think about this is for ENS, the starting point is the highest risk, then we apply a little bit of judgment. In G, financial strategy and risk management and management credibility are the most important factors. The others are, so occasionally, if you have a big controversy in the board and you have directors resigning, and you have all kinds of issues on the board, that could drive the governance score because we won't be comfortable with it. Or if you have a compliance reporting failure, you have to restate your accounts, things like that, that might drive the overall score, but otherwise these 2. So that's sort of how we think about combining. We don't have fixed weights. We have what issues we think are important, and then we have starting with the highest score and then applying judgment.
Okay, that's great. That's very helpful. Appreciate that.
Terrific. Well, thank you so much. Swami, you and the 3 analysts have done, I think, a great job of articulating what you've done here and what you've not done, and that's almost as important sometimes. And I think we've got a good sense from our folks of how they look at it, how they might use it, how it fits into the work they do. So before we close, let me invite Andrew and Kent and Mark to kind of maybe observe if there was something. What would you like to see next? How could this be more helpful to you going forward? Give you a chance to say something, to kind of make an ask of Swami before we close.
I could start. I mean, I would just reiterate the more transparency, the more information that you can provide in terms of the decisions that are driving some of these scores, I think would be helpful. Really looking for, I think what you guys have done, I think is really great. And, looking forward to you guys expanding in terms of at least my coverage area, which is states and local governments.
Okay.
Yeah.
Maybe go ahead, Mark.
Yeah, I would just say it's helpful, I think, going forward. Obviously, more sectors, more industry coverage, and maybe some more kind of industry level ESG thematic type analysis. They're already a little bit here, but maybe on an ongoing basis, kind of for pharma, once a year, kind of an ESG analysis that takes into account these credit impact scores would be helpful. But yeah, just more industries, more coverage.
Okay.
I agree with Mark. I think just being able to have something from an overall, what are the major, some of the major drivers for that sector. And I think you've highlighted that a decent amount, but then also maybe on a company specific level, if there's a couple things that really kind of stand out. I know you're trying to keep it standardized, so it might be a little difficult to that, but just having some of the things that they're doing, maybe from a product perspective or something like that, could also kind of give that intangible, idea of how we look at the credit overall.
Okay, thank you. That's very useful. We do want to have a standalone ESG section in credit opinions where you will see all this data, but hopefully in the credit opinion, some further discussion about some of these issues as well. We do plan to scale up across more sectors. That's definitely, on the plan. So in fact, we are continuing to score already more sectors, and you should see more scores being published in the next several months. The one question I would have, we don't have to answer now, or anybody in the audience, even some sort of feedback that I would like to get. My contact information is with Michael. I would love to hear from all of you. One of the questions we debated fairly extensively is this use of a 5-point scale, and whether that's enough. And what we decided was having a 10-point scale, for example. We were afraid that it would lead to false precision, that there really isn't the kind of disclosure in the analytics that is actually possible for us to really, create scales of multiple points. And that's part of why we started with this. And, we're obviously open to revising scales over time if we think that the disclosure, but if you really feel that 5 points is too little, this is really not giving us what we need, it would be great to get that feedback. It would also be good to get feedback in terms of the definition of the scores, in the sense of the issuer profile scores, just speaking about the exposures and what management is doing on the one hand, and the credit impact score focusing on, okay, how did all of this affect credit? And mind you, this is not the combination of the three. You have that's not the intent. This is standalone. It simply answers the question whether this affected rating or not. So, the definitions, how useful they are for you in constructing your portfolios. For example, we thought that if people had a screening tool to avoid certain risks, you can do it from a credit perspective by simply looking at these 15 factors and screening for anything you want. You don't want companies that are high risk for natural capital. You can screen out all the fives. So there are multiple uses of this. It's not just about credit rating. If you want to do a screening tool, you can do that. If you want to construct something where you tilt the portfolio with more in one way or the other, you can do that. So there are multiple ways this scores can be used. So we would like to hear from you about your thoughts on that and how we can make these scores more useful in your portfolio management.
Swami, this is Kent. Maybe showing the trends of scores and how they've evolved over time. So I know this is a static score at one point in time, but maybe showing some trends, and so you can see the improving trends or the worsening of trends. And some of these would be pretty helpful. So at least you can understand whether management has changed bad policies, whether there's changes in management teams that have really, we want to be looking forward, not behind. So something to show some forward trend looking I think you might have that, but that would be good as well, maybe.
Okay, and that's definitely on the cards. This is just our first score, but as we keep updating these scores over time, we plan to track and publish trends for each of these factors, in fact, not just at the overall level, but for each of the 15 factors.
Fantastic. No, thank you so much. And I think what we heard a lot of, and I think is a great message for anyone providing information to folks in our industry, is the transparency and the ability to understand what you did, because it isn't right or wrong necessarily, but understanding what it did is the only way people can really incorporate the good information and the work that folks like you do into their process for their clients. And that's kind of the bottom line that I would kind of take away from all this. With that, Swami, I'm confirming that we will be able to take those slides, share them with the audience, and that will also give people the contact information to reach out to you for some of that follow-up and feedback. And we thank you for the opportunity to do that. And I just want to, as we close, really thank Kent and Andrew and Mark for taking time, not just to appear here for 90 minutes today, but they took the time to go look through these reports, to sit down with us and chat about this. So they put a fair amount of time into this. And I really think it shows in terms of the quality of the assessment and the usefulness of what you were able to do and add to the conversation we had today. So thank the three of you very much for your time. Swami, thank you so much. We have recorded, and I believe we will be able to make this available so that folks can look at it afterward. We'll get the slides out to those who were registered, and encourage Swami's contact information there, and encourage anyone to reach out with comments and feedback and requests to Swami. And with that, I will say thank you to everyone and wish everyone a good afternoon and good rest of the week.
Thank you.
Thank
Thank
you,
you,
Michael.
everyone.
Thank you, everyone. I
care.
appreciate the
Thank
time
you.
taken as well by all of you.